Hello, everybody. Welcome back to another meeting of our Trend Following Trading Club. And happy Friday to everybody. Um, I'm resisting saying good morning because I know it's not good morning for some of you guys. Um, but I just love saying good morning. I love that it's Friday morning as well. Um, so we got a lot to do today, a lot to talk about, a lot on the agenda. No, not really. We just take it as it comes, whatever hits your mind. Let us know what you're thinking about trading in the markets and trend following or whatever. We'll twist it into trend following and tell you where you're wrong if you stray. And everything I say is like advice. Yes, trend follow. Everything. So I'm not going to be shy as I normally am not shy. Um, I listened to a good Top Traders Unplugged podcast yesterday, and I tweeted the heck out of it. It was really good. It was Rob. Rob, I enjoy listening to Rob. He's funny, and I do the YouTube version so I can read the transcript and copy and paste into a tweet and get him going. And he finds it irresistible to talk about me. He has to talk about me all the time on his podcast with Niels, and so that's fun too. He makes fun of me and my accent, and I think he said I had a Texas accent. I don't know where that came from, but he definitely insinuated that I don't speak proper English. So I'm going to work on that, and I'm going to work on my imitation of Rob. He imitates me in the way he thinks I would say something, and so I'm going to do the same to him. I've got to take this course on speaking proper English from UK English. Evidently, that's proper. So I'm going to work on that. Um, I was interested, though. Oh yeah, I wanted to mention it. Some of you guys have pointed out, and I have noticed that there is a fake Twitter account that looks like my account, and I've notified Twitter to that it's fake, and even some of my friends follow that account. But it does look like my account. It's just a complete knockoff, ripoff. But I don't think it's anything nefarious. But it's probably Rob too. I mean, could be him. Just once again, he's imitating me. Wants to have a Twitter account that looks like mine. I'm just joking. I love Rob. He is. I'm really glad that he's coming over to some of Richard's ideas and claiming them as his own. That's fine. If you agree with Richard, if you agree with me, and some of the hardcore classic trend followers, you can pretend you came up with the idea. We're totally down with that. No problem. But Rob did come up with an interesting idea or comment that I didn't tweet, but I wanted to start off with this idea that he came up with, and it was the one where he imitates me as to saying that instead of a diversified portfolio of stocks and bonds and trend following, I would say just trend following only. And of course, he's correct. But he wants to leave open some of his portfolio for stocks and bonds, 60-40. And he said he wants to take advantage of the stock premium and the inherent returns in the stock market. He doesn't want to do trend following only. Why not just do the stocks as well? So I was just wondering. I think we've talked about this before, but I was just wondering that um, how much of the stock premium would we even lose if we trend followed those same stocks? The stocks have trended so well in some years recently; they've been the best trenders. We've seen amazing outliers in those stocks. And so it seems that they would perform pretty well, and we could capture some of that profit or a lot of it and then limit the losses. And although we have seen a lot of V bottoms recently in the indexes and where they just hit the bottom and then rally. And so the buy and hold is going to do a lot better in those scenarios. But I just wonder, is it the stocks themselves that have this premium that they give off, or does it have to be the index, S&P cap weighted index, that is part of this premium, or can we just grab this free profits that is inherent in stocks by altering the returns a bit with the trend following strategy? And someone, as I've said before, needs to do this back test on each individual stock in the S&P 500 or lots of those stocks and see what a good trend following, long-term trend following would look like trading the individual stocks, not the index. That's, of course, I wouldn't agree with that. And then maybe it depends about how long you look back. I'm sure it's underperformed in some of the recent years, the trend following of the individual S&P stocks versus just holding the index. But my guess is over a 20 or 30-year period, a trend following those stocks would be much better, uh, than and eliminate a lot of the really unfortunate drawdowns. So, anyways, if that interests anybody, we could talk about that or anything that's on your mind.
G'day, Jerry. G'day, everyone. I loved your intro, Jerry. I was having a good laugh as you were having a go at Rob. I think I love the two of you in operation. It's great to see it. There's room for lots of laughs.
That's right. It is. It is a lot of laughs. You're a pretty funny guy too. So I enjoy when we all got together or just listening to you and Niels. And I know that's coming up this weekend. So if you wanted to give us a preview of what you guys are going to, some of the topics that you're going to talk about, that'd be fun as well. But go ahead.
Yeah, so I was just I was talking to Niels before. So the ones we're going to lay on the table is specifically referring to outliers. So the two topics we're going to be talking about is this research that Jean-Philippe Bouchard put up, which I think is really important in respect to defining what these outliers are. And then I thought it might be a good opportunity to talk about some of the things I've been talking with Bruno about in relation to using the look back as a method to distill a greater relative distribution of outliers in our trade distribution. So they're the two things we'll be talking about tomorrow. It should be a good session.
Hey guys, I haven't spoken up much, even though I've been here every week since last summer, listening to all the nuggets that you share. But mainly because maybe because I'm a equity trader in a systematic way. So in terms of classical trend following, I don't have much diversification when it comes to your opinion, probably. Even though I do diversify across strategies, trend following, mean reversion, momentum, and also timeframes, mostly daily and weekly bars. But one idea when it comes to stocks, and I was wondering what you think about it, is momentum. So I understand that you, as classical trend followers, you are looking for stocks that are uncorrelated. But actually, in my opinion, when it comes to stocks, the correlation is like a benefit. To me, it's like a feature, not a bug. That thanks to the correlation among stocks, you can use the momentum to pick the ones that you are going to trend follow. So I was wondering what you think about that kind of stock selection.
Yeah, Marcus. Look, in my opinion, I think momentum is sort of like a subcategory of trend following. But when we apply a strict momentum strategy, such as a relative momentum strategy, which is working on the principle that an instrument that exhibits strong momentum that's likely to endure and therefore you adopt a rotational process that therefore selects those with strong positive momentum or select those with strong negative momentum, and it's more a case of excluding those that don't exhibit that. I think that's something that I would actually tend to treat in more the convergent camp. In other words, I think that's a feature that you find in more the normal distribution of the trade distribution, as opposed to outliers, which I think absolute momentum models specifically target. So I tend to view things in two camps. There's those strategies that operate within the tail region of the market distribution of returns, which is the absolute momentum and the options, buying the calls, selling the puts. The long vol strategies fit into the tail region, but all of the balance of other strategies are either sort of like a strict convergence style, or they're a blend of both the sort of the tail component and the normal distribution. So I think the absolute trend follow or absolute momentum is a more pure methodology that is specifically focusing on the non-linearity that exists in price movement or the major price moves.
I was actually thinking a week ago and even 2 weeks ago to ask you, Richard, about your. I remember you told that your New Year's resolution was to get into single stocks, and so I was wondering if you've already been thinking about that, about the approach, how you're gonna treat the single stocks. Will you use the same principles and approach as you do with your general trend following view, or are you gonna treat the stocks somehow differently? Have you thought about it yet?
Yes, look, I have, Marcus, but I do cheat a bit because I specialize in these instruments called CFDs. So when we're trading, when I'm trading single stocks, I haven't started yet, but when I plan to start trading stocks using CFDs, we get the benefit of the fact that the data has already incorporated things such as dividends, splits, all of those difficult things that you need to adjust if you are purely trading stock instruments to create those long-term series to do your back tests. But in my CFD world, fortunately, the data providers already do that for you. It's effectively like providing continuous contracts in futures by adjusting all of the variables you need to include when you are treating stocks separately, such as the impact of dividends, the impact of splits, the impact of bonus issues, all of those things. So, but when, of course, you pay a price for that benefit or that convenience offered by the market makers with the implicit costs assigned to those CFDs, but because I am targeting these outliers, the costs to me, such as the holding costs, the spread, and even the slippage, is immaterial in relation to the significant moves of those instruments. So when I plan to trade stocks as individual CFDs, I'm going to be trading them exactly like I trade my commodities, which is different to how I currently trade my index CFDs. With my index CFDs, I class as a separate grouping because the index itself is a system unto itself, which applies a bias by virtue of the method of index construction. So without that bias with individual stocks, I'll be trading them both long and short, exactly like I trade a commodity CFD.
All right. To me, CFDs seem so expensive, but I'm in the EU also, and even with a low-cost brokerage like Interactive Brokers, they add like 1% of interest to people who are under the MiFID, or I don't know even how they pronounce it, MiFID 2, which applies to the EU customers. So I don't know. To me, CFDs seem pretty expensive. Maybe it's other way around in Australia. I use CFDs only to short the sector ETFs because thanks to the EU rules, I can't buy or sell the US ETFs directly. I can trade them in the UK or in the EU exchanges, but there the trading fees and costs are like 20 times higher than it would be for the US ETFs. But another idea I wanted to say about the absolute momentum, I actually use both ways to diversify. I use absolute momentum to pick some of the largest stocks in the S&P 500 index. So I treat them on their own price data and trends. And then I use relative strength to pick the best performing stocks in the best performing sectors and treat them with also trend following rules. But I most often don't even know what the companies are behind the tickers. So in that case, I use relative strength. But the more known companies, bigger companies, I trend follow using absolute momentum mindset.
Hi to everyone. I want to say that I agree with Marcus that it's a very expensive CFD, especially if we are talking about commodities prices. I don't know, maybe there are different CFD programs, so maybe different brokers give different terms. I don't know that exactly. But I'm talking about such CFDs that I have seen, and it is really commodities prices at least very expensive, very expensive. If you, there.
Yes, look, I agree with you both. If you have significant capital, then you wouldn't be applying CFDs. But with limited capital, that, for instance, I have and a lot of other retail traders might have, there is a benefit with the CFDs. Yes, there's higher costs, but the benefit from the significantly enhanced diversification you can achieve from CFDs, for instance, a $50,000 account might be able to support 100 markets. You wouldn't get that in the futures space or in the individual stock space. You'd be needing, maybe capital of 500,000 to achieve that, or more, 1 million to achieve that level of diversification. So the cost or the impact of the transaction costs are significant, but I'm referring to capturing these outliers. I'm referring to capturing 20, 25 ATR, R sort of movements with my significant trades. And when you start looking at the impact of those significant price moves, you realize that the transaction costs are a small price to pay for that significant potential. But CFDs is something I would recommend for the retail trader with limited capital to get their trainer wheels or to get their bikes with trainer wheels, thinking about how to use these classic trend following methodologies with diversification to achieve this, this aim of what the professional managers are doing. But in the absence, so I wouldn't be recommending using CFDs to trade convergent methods or any other method because there's simply, I don't think there is sufficient edge to accommodate those increased costs. So it's really sort of like an intermediate or an introductory step into the world of trend following to get the leverage necessary to really start looking at principles of diversification. So, and also in Australia, fortunately, we don't have the same levels of restrictions as a lot of other countries, but there is one inherent restriction, which is you need to be classified as what they call a professional trader to get the benefits of the leverage. Otherwise, if you are classified as a retail trader in Australia, the regulators stick this significantly reduced leverage onto you, which means that your ability to diversify into CFDs is significantly restricted. So that's just some of the issues over here in Australia.
I like your way of thinking because I'm sure, absolutely sure, that we must think, act, and do all what we do in the course of trend following. So we must have a mindset of trend follower and mindset of a diversification person, diversified portfolio person. So I think that, of course, if we have not any choice and our capital is limited, it is better to have a lot of markets with a high cost than less markets with a low costs. And one business person said a good phrase once that it's better to have 30% from a big profit than 100% from nothing.
Yeah, in the EU, actually, also if you have like 500,000 account, you can classify as a professional, not a retail, and then you can trade the US ETFs and other stuff. I myself, I'm a retail trader. My account right now is a bit below $500,000. I guess they need to have it like 500,000 euros. So for me, it's a bit more time needed to get there, but I'll hope to get there soon. But with CFDs here in EU, at least the reason I use them to short sector ETFs is because in case of shorting the CFDs, as I understood, then the interest is like the other way around. You don't pay the interest unless it's negative. So for shorting, it seems that the CFDs are a bit cheaper or better than just buying and holding them.
Yeah, just check a few of them, Marcus, because you'll find that there are long opportunities and short opportunities with what you call positive swap. A large number of them are negative swap, some are significant negative swap. And what that means is a significant negative swap, they do incur a significant holding cost when you're holding them for a period of time. But with a small negative swap, it's sort of fairly immaterial for my interests. But with positive swap, you get the benefits really of a long carry, as well as you can be long and short in some instruments with it. So the way they're calculating the swap is by looking at the relative interest rate differentials between the numerator and the denominator of your CFD, and that determines the weight of the holding cost and whether it's positive or negative.
Richard, how would you compare all of that to? I don't know if Interactive Brokers is available in Australia, but I've advocated that people use Interactive Brokers. You can get leverage. I'm not sure. We get 6-to-1 leverage in our stocks, and but maybe you'll get no more than 2-to-1. But still, with Interactive and some of the other stock brokers, you can do partial shares, fractional shares. So you can do ETF, commodity ETFs, commodity interest rates. I'm sorry, ETF interest rates and ETFs that have commodities and currencies, and build a portfolio. You do pay the ETF fees, which are, some close to zero and some 100 basis points, but still, you would think that you could build a pretty darn good portfolio and get around this idea of being small just through the fractional share idea. What do you think about that idea?
Yeah, look, Interactive Brokers is great, but look, what I actually do in my world is I'm an education provider. So what I do is I try and get retail traders on the right track. Now, in our retail world, particularly in Forex and CFDs, it's a world of scams. So I pride myself on educating retail traders in the correct way to think about, earning an income, a sustainable income, and therefore I am forced to therefore adopt the techniques that my retail traders adopt as well, because I like to practice what I preach. So in that relationship, I'm using leverage of 500 to 1. Hold your ears, everyone, 500 to 1. But that gives me extensive diversification potential. But remember, leverage is not a bad word when you risk mitigate with our initial stops and our trailing stops and our small bet sizes. It is a bad word for people like Nick Gleason, who enter these trades with no sort of risk mitigation methods in their leveraged instruments. So that significant difference in leverage allows me to get traders on the right foot with, say, $30,000, $40,000, $50,000 and at least teach them the techniques with the aim of, well, if they like what they're doing, then this is a sustainable trading method. And as you build your capital, then you slowly migrate over to things like interactive brokers, or you slowly migrate over to things like futures trading and things like that. But get on the right path first, rather than continually blowing up your accounts for many, many, many years and not getting anywhere. There is a path you can take, and I hopefully offer that path with what I do with my trading forum and the retail brokers I'm trying to sort of educate.
Yeah, in Europe, IB offers like 4 to 1 intraday and 2 to 1 overnight. But I'm an end of day trader myself, so I don't use that much leverage.
In listening to the Derek's Clubhouse yesterday about trading infrastructure, I didn't have a lot to add. I wasn't really sure if I knew what the exact subject was, but I was listening for a bit, and it just made me think that what a daunting task it would be to start trading for clients. And it seems that what the path you're on, Richard, of helping retail traders with the right methods and the right structure to get going and kind of make some money on their own, seems so much like a more sustainable for almost everybody when you listen to what it takes to meet all the regulations and the proper compliance and due diligence to be kind of institutional worthy of getting clients money. We complain on the podcast that people don't invest in trend followers or classic trend followers, but they go to these big CTAs with lots of AUM that water it down with divergent, convergent trading and vol targeting and cap the possible profits. But it seems to me that, I mean, I have my fund and I have been a big organization, but I think I was just getting the impression yesterday that if I really wanted to ramp it up and be worthy of institutional investments, I would have to start listening to all the stuff that Derek and his friend were talking about, which is just this daunting task, that, okay, I'll be fine just continuing to trade my own money with a couple of clients or a few high net worth people who don't know that I'm just kind of a small company with my fund and not able to attract and not wanting to attract the mental cost of I think what they were talking about just was like, I'm not going to complain any longer if some big institution doesn't come to me and say, I've seen your performance, it's so wonderful, let me give you money. Now I have a better idea of what it would take, and I'm not willing to give up my wonderful lifestyle.
I want to ask. Okay, I want to ask a question that is really important for me, because I know that if we read or listen some high performance people, they all say have a big dreams and have clear goals. And I see that from trend following traders, high performance traders, I often heard that it's very problematic now to have established a fund because of regulation rules or something like that. And so, what do you think? I'm asking Jerry and Richard. What must be a dream, big dream of a trend follower? Maybe be a writer that writes about trend following, maybe something like that, maybe. But really very interesting, your thoughts.
I'm a big believer, Oleg, in being a master of your own destiny. So I'd be saying try and do it yourself. But of course, that's with capital constraints, it is a real issue. So really, to me, there are two alternatives. Either you put the trainer wheels on and you do what I do in the world of high leverage with an instrument that allows you to achieve levels of diversification to mimic what the professional fund managers in trend following, classic trend following do, or invest directly with those classic trend following fund managers. They're the two options for me. But if you want to go down the path of setting up your own fund, well, I had 15 years of my life in compliance for fund management. And I know just from compliance how comprehensive and difficult that was. But from Derek's discussion yesterday, you've got the IT components, the all of the infrastructure associated with it. What that means is that you'll be investing 95% of your time in things other than trading, to try and get that all happening. And the joy of what we're sort of doing with, our trend following is totally lost in that process. I personally think so. Either I do it myself, or I would be investing with those classic trend following managers. There are some solutions, such as there are some platforms like I think Jack Swager's got a fund seeder program, and there are some, Darwin X offers the ability to trade with other people's money without that. They carry all of that infrastructure and the management of compliance and all of that thing under their umbrella, but they allow traders to use that infrastructure and trade other people's money. So there are those options, which therefore mean that 90 to 95% of your efforts are invested in something you love, as opposed to 90% in compliance, regulation, IT, tech, all of that sort of stuff. But what also Derek was talking about, I think, is what a lot of convergent traders need to invest in. I personally think there is a lot less infrastructure required for classic trend following than there is for things like, of course, high frequency trading, which requires intensive infrastructure, convergent techniques, which require very low slippage, all of these things. So, different techniques have different costs associated with it, but others will know better. I'd be interested in what Jerry and Bruno have to say about this.
Yeah, I actually was quite surprised yesterday because I was expecting, and we touched upon the topics and the various libraries and software packages and things like that. But I think it sounded a lot more serious and a lot more you know compulsory than it is. I mean, my experience is that I have a small business running mainly my money, but with other people. I'm set up as a fund. There are a lot of solutions that one can go for away from the IT stuff. So, for example, compliance and all this trade management and stuff like that. And I did say it in the um, in the discussion yesterday. I mean, there's a ton of other people that do compliance for you. So you just plug in to their workflow and let them let them check your trades to their high content. I'm doing probably a tenth of what Derek was talking about. Of course, I mean, be systematic. You have all your trade records generated by a computer, so they're there and they're very auditable. But some of the talking about message buses and stuff like that. I mean, it's a lot of IT infrastructure and a lot of cost and servers and stuff like that. I mean, I don't do any of it. I simply plug into somebody else's computer and let them check, and that's it.
Yeah, I like that. That's what I was hoping. But I definitely was in that situation even with a large staff. My days were spent not on research and trading. I've thought more about trading and research, since I dismantled my staff and went kind of family office over the past few years. than ever, basically. And of course, my trading and my thought process has gotten so much better. And another thing that took away, that was so much of a burden, and I feel like I'm whining now, is I used to, when I first got into the business, I would meet people at conferences, and the CTAs sometimes would try to act like they were hedge funds versus a CTA, and there is kind of some major differences, but they would say that people would ask, like, what's your fund doing, or tell me about your fund, and I would think to myself, I wish I had a fund. I have 50 managed accounts with different fee structures, different FCMs and brokers, and some have notional equity and some have all cash, and it runs the gamut. So this is another burden as well, having a company with so many moving parts like that. So not only the compliance, but shutting all of those managed accounts down, and usually the managed accounts, especially in the early years, we would get these accounts only because we were willing to take them. Like we had good performance, but they would be small or high fees, maybe low fees to us. And it was really just getting that money because people were raising it and trying to find someone to trade it. And there I was, and I would do it. And I found out over the years, people are really serious about investing with me because they want to invest. They'll be perfectly fine coming into a fund. Like 90% of all the other hedge funds, it's a fund. And CTAs taking on all these managed accounts was such a burden and a distraction from a singular focus on this LP or non-US fund, and where you could focus on the trading and the components and adding stocks and exotic commodities and currencies, which is what I do now, and singularly focused on making the fund better and getting away from all of this admin was such a relief. And I knew from the very beginning it was a mistake. And I would go home at night just saying to myself, this is a mistake. I need to focus on growing less and not making as much income, and more focus on my trading and making this portfolio amazing and perfect. So there's many ways we as traders who are trying to run a business get distracted away from trading and learning how we should become better.
Yes, and what do you think is maybe the best way, or maybe one of the best ways for a trader, for trend following trader especially, on his career path?
And more to Jared's point, I think now we have legal structures that allow you to move away from the nightmares of managed accounts and adopt a fund structure. But the fund itself, um, it's more like a private fund than a public. I'm using the term private and public a bit loosely here, meaning the fund is an audited vehicle. It sits inside an investment management platform and all of that, but it's not as widely or as closely syndicated as the manager or the people running the business want. So I think in terms of flexibility, and this is infrastructure. We didn't get to talk about it yesterday, but I think it's very much an infrastructure point. There are structures now. It's not just a big dichotomy. Oh, you are a multi-billion-dollar fund, or you're sort of condemned to doing what Richard was talking about, play with derivatives and not with the underlying vehicles or the structures that you like. I mean, there's all sort of stuff in the middle that should be gives a lot of opportunities and should definitely be used and exploited, because it adds a lot of flexibility to do exactly what Jerry was talking about. Moving away from all these non-trading chores and just push them down to people. Obviously, they are a bit expensive because, as you can imagine, a compliance consultant will charge a few £1,000s in London, or a few tens of thousands,
Whoa.
probably the same in the States. But I think it's worth the expense.
I'm not that cheap, Bruno.
When I first got into the business, I was fortunate, that I had a 4-year track record, and so I had some credibility, and I was able to raise a bit of money, and then the markets were good. 1988, there was a big grain move, and but even after trading for a while and building and continuing to build up my track record, there seemed to be this focus on what was called fund of funds or whatever, to find the next great small trader. And I would get frustrated, like, well, why are you trying to find this needle in a haystack and with probably really little of a track record? Well, because people were just hungry for something new and different. And there was this idea at the time that I would meet people who said, I was the first person to give Paul Tudor Jones money, and I need to find the next Paul Tudor Jones in order to make a big score. And I think that now I don't hear that nearly as much as I used to. Let's go out and find this trading talent, which I think is fine, because I think systematic and is the way to go, and not discretionary. But you would think that there would be more opportunities for, or hear about more opportunities for young, or not even young, but small traders with an idea and a difference, to be able to have some instant infrastructure and incubation, I guess is what they called it, to find some talent. And I guess that does occur at some of these places like Graham and Point 72, which are, when I hear about from them, it's pretty cutthroat. They would never sit through my drawdown, regardless of my profits, and they would never allow me to get away with, well, it was an open trade profit. I gave most of it back. They wouldn't go for things like that. They want not only a good overall Sharpe ratio for the firm, but they want each individual trader to have a good Sharpe ratio, I believe.
Yeah, I want to use the opportunity to say how much this Clubhouse has helped me mentally. And, even though I'm an equity trader, all the mindset, all the approach, the logic behind trend following, and all the stuff that you talk about here every week, it applies so much to what I do myself. So I remember last year, like when I was holding these big trends like in Google and Nvidia, Tesla and Microsoft, and I was listening, and like Jerry says, that just don't look at the open profit give back, and ride with the trend systematically. So it's quite hard. Like everyone on Twitter are saying, like, now it's the time to take profit. It's gonna reverse, and a couple of months later, it's like 30-40% higher. So yeah, at some point the uptrend will end and it will bend down. I will get out. But yeah, I just wanted to say a big thanks about all the mindset stuff here that we can listen to. And I have used the Clubhouse app's feature that you can save some 30-second clips to your phone. So yeah, I have used that feature. So when I go to workout, or even before I go to bed at night, I listen to those over and over again, and remind myself about the mindset. So that's a big thing.
Agree with this, that our mindset is very important to all of us, because, for example, if you even don't have a decision, if a trader or a person even don't have a decision to be a trader, or to be a businessman or something like that, to master the skills, some person think that when I will have a lot of money I will start, and I have seen such people. When I know one guy, and he said that when I will have more money I will start to be a trader. And I said to him, no, don't do this, start today. don't do this. And he said this in a few months, and then maybe 1 year passed, and he said, when we will have more money, I will start trading career. So no, start learning, start to do every day consistently something in the direction of what you want. This is the key, I'm sure.
I feel like we're living in an interesting time. You know, I'm trying to figure out how to make that next leap and get recognized myself. But the fund seeder with Jack Schwager, I think, does an excellent job of that. And I've had, I do have contacts, who work at these larger firms that actually are using his fund seeder, which I would recommend to everyone to link into your account. Um, yeah, it's great to have that 4-year track record. Um, I'm personally trying to speed that up by having like a newsletter. I think, but that I think is what's interesting. Also, is through social media. If you can wade through all the charlatans on there, and you can clearly describe your methodology and give a real time track record. I think it's an interesting time to get noticed for the smaller investor.
Yeah, interesting, Andy, because I adopt this principle called the Feynman method. So what that is, it's a learning method where you find that if you start understanding things to the level where you can teach something, you find that by teaching the principles, you're forced to look at things from a lot of different perspectives because you're teaching to a wide audience who all sort of accept the principles of trend following, but from different angles. So what you find when you get confident in your method, I would be saying start teaching it, start learning how to teach, because I think the greater learning is actually achieved by the teacher as opposed to the person that just accepts, reads, and understands. So teaching is a method in the Feynman method that really sort of it amplifies your understanding of the underlying philosophy. So that's where I started looking at how to get my edge. Oleg mentioned, how do you get entrance into the fund management industry? Now, I'm late on in my life, and I think it's particularly hard. And I think Niels, in his podcast with Rob, said a very interesting statement. He said, the way to do it is to get recognised by the professionals, and the way to do that is to assist them, give them some angles that they haven't considered before. Um, be a help to them as opposed to someone who's just asking for a job. Actually look at innovative ways that you can add to their cause, add to their benefit. In Neil's case, it was a case that there was a person who introduced him to a student group, which gave Niels a direct benefit. And it's those sort of things where you want to offer something rather than just sort of asking for a job. You want to offer something that's the sort of gives you that little Pareto edge in this competitive world of employment, and you target it towards something you love. And so I'd be saying use the Feynman technique, develop your capabilities and your understanding, and I'd be saying look at how you can assist the FMs that you're attracted towards, as opposed to necessarily just applying to them.
I love that advice, and I agree. I mean, since I've even started just writing, and that's what everyone says, like just start writing, and I've just gotten into so much detail, and it's really been extremely helpful. I almost feel a bit selfish like by writing it, because I've gained so much from it. So I love that. I just recently I gotta look more into Feynman, Professor Feynman, because I follow something on Twitter that, and everything that this Twitter account posts as a quote of this professor is like just gold. So do you recommend like just a book describing him?
Yeah, look, even better than that. He's got a lecture series that he did, I think, at Cornell University. It was back in 1967 or whatever. Now, even for the lay person, if you listen to these video series, which is on fairly complicated sort of physics topics, he does it in such an inspirational way and in such a simplistic way that you really know he understands what he's talking about, and he conveys it in a way that makes the sort of the naive person actually understand what they're talking about. So where I have my gripes with industry is in the technical baggage that's associated with their explanations. So I get lost with all of these high level complex talks that a lot of tech people and IT people, they expect you to understand these principles before you can even sort of, or at least understand the lexicon before you can understand the deeper principles associated with it. So I say strip that baggage away. You should be able to, if you really understand something, you should be able to explain it in a simple way that you can convey to a child who's got no experience in that area. And if you can achieve that, then you know you've got something. And that's this level of amplification you achieve internally in your own abilities as well. It gives you this amazing power, and it allows you to sort of choose your own destiny.
I love it, Richard. I'd say we park our cars in the same garage, but that's very much my philosophy as well.
Yeah, it's a funny thing about teaching what you do. So I'm from Estonia, and we have population of 1.2 million people. So it's a small country, and I started a local YouTube channel. It's in Estonian, so none of you would understand it what we talk about there. But yeah, I started like a bit more than a year ago a YouTube channel in Estonian about the stock market and everything, with another guy who is an investor and has been a fund manager in Estonia. And it actually got quite popular. We have like over 1,200 subscribers, but only 1.2 million people population. So compared to like relatively to US, it would mean like 300,000-400,000 subscribers. So that's in absolute terms, it's a small amount of people following, but relatively to the population, it's quite good.
And I want to say that Russian people know very little, much less than European people and United States people, or maybe Australia or New Zealand, or maybe even India and Africa. Because Russian people have because maybe of Soviet Union background, where was no business, no trading, no people even did not speak about this. So people don't know about stocks, about the markets, very little. And there are a lot of companies. Some of them maybe really try to teach people, and some of them not. They use brokerage firms with very high leverage. They make money in an honest, dishonest way because people don't understand how to trade the markets, and they don't teach them in a proper way. So a lot of I think all over the world there is such a problem that people in general don't understand the principles of investing, principles of trading. But in Russia, this problem is, I think, is a very big problem.
And that's Oleg. Those are the people that get that start to swoon whenever they hear someone, explaining things based in Greek letters and very complicated formulas with all kinds of squiggles in them, and I'm making fun of it, but I've done it in my life as far as understanding these things. But if they just their eyes roll in the back of their head and they see some fancy formulas, they're like, well, this person's smarter than me. I'm going to give them my money. Whether it's
Uh,
just
I want to tell you one thing, and I had told this before, and it sounds like an anecdote. One guy from a Russian company called me. It was a cold call manager from a company called me and said, "Hello, I'm calling you from a Russian hedge fund, and our traders make 10% consistently a month." Um, and I said, "Wow, what are you talking about?" He said, "It's a very big percentage. It's not truth." And he said, "Why? If I would say 100% a day, it would be a big percent. But 10% is it's very easy. It's very safe. It's very good, and people believe in this. People in such companies, a lot of money in such companies. I have heard. I don't know it exactly, but I think people believe in this. People watch American films, Hollywood films, and believe that there is a very big money industry. There are a secret source of making money from nothing, and that if you are a conservative trader, you can predict the market and have 100% a year without any risk. And I saw an investor. I was talking once 5 or 6 years ago with one guy from Moscow, and I have heard that he invests from 1 million United States dollars for each trader. So he is not poor guy. He has money. And he said, I want 100% and a year. I want a drawdown not much than 30%. And I want a drawdown that will last not more than a month. And if a trader will tell him that it's achievable, he will give him maybe 1 million United States dollars. And so such awful things in the industry, such unprofessional investors, such unprofessional traders, and they meet each other. Such a situation.
these are the guys who ruin it for the rest of us. I'm exploring opening a CTA, and my friend, in the industry says you just have to realize that ever since John Corzine and MF Global, people are, some managers still are a bit shaken, with having a futures based fund. And I'm just wondering if you guys experience that, especially, the guys who've been around through that whole MF Global debacle, if it really did affect, people willing to give you, put money in a futures, proxy. And I'm curious about that.
I don't remember too much about MF Global having much of an impact, but definitely Madoff and the 2008. I think that I don't think I had heard that too much about needing an administrator, a fund administrator, until that all happened. And our very great accounting firm that did our daily reconciliations and prepared the income statement and balance sheet and the K1s for our funds became an administrator, which I think means that they are involved in all the cash transfers back and forth, of course. And that, I think, was a big deal to people. I definitely remember that. I think the people who lost money at MF Global, that was a big deal to them, of course. I just, I have these stories about Corzine, who ran that firm, which was, I think he was just wanting to, he got sort of kicked out of Wall Street or being governor and wanted to go to this firm and turn it into a hedge fund. And, well, anyways, the reason I didn't like this guy so much is because I was at a dinner with him once, and he was the president or whatever, chairman of MF Global. And there was this dinner at a Miami conference. These conferences are coming up next week, Context and MFA. in Miami, a lot of fun on South Beach on those conferences, you know. So he had a dinner, and I was invited to this dinner, and there was some sort of appetizers or something in the middle of the table, or bread or whatever, and he just kept hogging it for himself. So he got off with a bad start for me. So, but I don't remember too much more about that.
Cracking me up.
I think there is so much in the buy side and the sell side that is infected with this virus of traditional economics that, um, you know, I personally think that this whole sort of financial system is corrupted to the core. There are a very few traders, for instance, trend followers, who I believe do understand the principles of risk management. But I am I was a bit of a compliance nuts back in the day, and I really hate taking losses. So I really view risk management seriously. And this whole approach to trend following fermented this philosophy to me that is so far, this is why I refer to it as superior. It is a superior method to alternative methods, because most other methods are relying on principles of correlation as a basis for risk management, where we know how fickle this correlation is. So to obtain these smooth portfolios where people are investing in multiple different risk premia to obtain this, to me, that's this window dressing, corrupt at the core. They don't understand what true risk is, and they inevitably set themselves up for a major fall. So I think that there are very few models out there, apart from this classic trend following that we talk about at this Clubhouse, that have got a firm grip on what risk management is. And that's the only way I would invest my hard-earned monies into that principle, because, you know, being an accountant, coming from compliance, I treat this risk seriously. And I think really the first course that every trader needs to understand and do is a course in due diligence before they even learn how to trade. And if they did that due diligence, they'd be forced to look at the validated track record of sustainable long-term fund managers. And in that record, you can see what survives and what fails. And these methods that, are catchy to the retail trader, that the charlatans basically promote, these risks of fantastic sort of returns, is inevitably attached to extremely high leverage. They inevitably fall over. And I just think that this whole industry is corrupt to the core, and it's very much like that Matthew McConaughey sort of expression at that great film with Leonardo DiCaprio, where he talks about the Fugazi. You really see how the sell side basically do take advantage of the buy side from this inevitable lack of understanding of what due diligence is actually all about.
But I'll stand by my prediction that, due to history, that this will be uncovered and money will flow to divergent, diversified traders eventually. And it may not be something that I end up seeing, but the CTA industry that does the maximum diversification allowed in the liquid markets, shorts and longs, with the systems that let profits run and take small losses, it will attract uh, more assets, and the vast majority of assets eventually. This whole idea of the stock premium and an 8% return on average and a 50% drawdown will not stand the test of time, and how wonderful commodities are, and shorts. And this was one of the things, I'm going to diverge a bit here. One of the things that I did not bring up, we were talking about short trades a few weeks ago, and I was bad mouthing shorts and trying to find robust ways to take fewer shorts. And but one of the things that is so important, like, now is a much better time to add stocks to your portfolio versus the end of 2019. In 2019, when I was adding more stocks, almost all of them were breaking out to the upside. So I had no protection with the 2020 February sell-off. Now, so many stocks are in downtrends, and over half the stocks that I randomly look at or add to my portfolio, they're in downtrends. And so, coming into a period that you can't foresee, where there's going to be some big sell-off in stocks, which I'm not predicting that we are coming into that. The best defense that you could possibly have is just having some shorts anywhere. Commodities, well, that's not possible now, but the currencies and the bonds are short, and then you also have a few stocks that are short. It's much safer now and than it was a few years ago before COVID, and that's so important just to take up that risk space, that space in your portfolio, and not have too many longs. I like those periods. I think 2014, I traded a lot of stocks and I made a ton of money, just mostly from being long a lot of stocks. And then, of course, a year or two later, I gave a lot of that back. I love those periods, but only when I'm in them and I'm experiencing them. But on a day-to-day basis, where I'm trying to manage risk, I really appreciate taking up some of that risk with opposite positions.
I mentioned a tweet earlier this week about how drawdowns to the trend follower are not drawdowns for these alternative methods, because there's a silver lining to the cloud of drawdowns for trend followers. And a good example is November 2022 or 2021 with the Black Friday event. That basically took out a lot of my long equities in my indices. They were basically vanquished from the portfolio through that event. But now everyone on Twitter is so worried about this small fall in the Nasdaq, this small fall in the S&P 500. This small fall has been not accommodated by any interest rate rises. It's just the prospect of interest rate rises. So imagine when interest rate rises happen, how far could this fall be? So where I'm very thankful is that this drawdown has allowed me to reset my portfolio. It's actually readjusted my portfolio to take on future risk, as opposed to those poor blighters who I feel very sorry for now, who are incredibly long these equities, long these cryptos, who are now sort of being short squeezed to death with this very small move in the S&P 500, where they've just held on to that risk. They haven't released that risk. And where a trend following model differs from alternate models is it's got risk release valves that release that risk with these adverse moves. So you find that the drawdowns end. They're not perpetual things, unlike the travel towards risk of ruin associated with those alternative methodologies that hold on to those risks. Because as you get further into your drawdown, you find that your portfolio is adjusting, releasing all of the dead wood from the portfolio so it can absorb this future risk.
By the way, I was thinking about what Jerry said. That I was thinking a few days ago that I think in trend following space there will flow a lot of money sooner or later, because people might, well, like Margie Brinsky said, that people's opinion change very fast, and now we see a period of good trend following performance, especially in commodity space, and I think it will the interest to trend following space will increase in such a moment, and our job is to do it consistently in all the environment the same, follow our principles, follow our rules, and to survive in this game. And of course, if we will do so, like Jerry said, trade small, have a lot of diversification, and so on and so forth, the success will be with us.
If anybody wants to speak, raise your hand. I'll get you up there. Go ahead, John.
Yeah, morning, folks. Thanks as usual for this. Agree with all of what you're saying, but I'm really curious about what you guys think about the accessibility of trend following. So, as a retail investor myself, if I wanted to invest, I need to be an accredited investor, which means I have to have a lot of money. And depending on the country you're in, you're looking at offshore investments or things like that, right? So there's no, I've looked, there's no great ETFs for investing in some of these funds. I think like Dunn might have a mutual fund, but the fees are very high and so on. So uh, I agree philosophically. I'd love to see more people invest in trend following. I'd love for it to be easier for myself to spread myself across some fund managers, but there aren't really any great vehicles that I know of right now. I'm curious what you guys think about how that could change the industry.
Jerry, you've got a vehicle, don't you?
Yeah, our firm has a small mutual fund. It has had good performance, and it's just basically trades pretty much the same as my private fund, but it doesn't trade as many markets. And of course, that's a sad story, of course, because trading more markets makes performance better. So they're considering adding more markets. I there are some other, and these funds carry an expense ratio of less than 2%, which is kind of high. But um, then I think there are some other successful funds out there, that CTA funds, that do pretty well for low net worth or non-high net worth people. So they're probably going to get better. I did look at some of there's ETFs as well that have had some decent performance. And but I looked into one of them the other day that disclosed their holdings, and I think there were 40 markets. So I don't like the 40 markets. I like 100 markets and a lot of uh, currencies and commodities and stocks, and almost none of them trade single stocks. So that's another problem. Yeah, so this is what we're here about. If you can't get what you need from others, try to do it yourself. But um, it does seem to be kind of not the perfect optimal situation to access CTA trend following.
Yeah, I mean, thankfully I'm in a position where I can have a small portfolio of my own and trade, but like when we're talking futures, that's still a decent amount of money for most people, right? It's like, how do we get it where someone who's just starting in their career when they're, in their 20s and has, they're just building up a pool that might only be $30,000 that they need to put in a retirement account or something like that, give access to them so they get those, decades of performance out of it.
I know there are some vehicles with CTAs where you might need a minimum investment of $100,000 to get exposure to the CTA. But that is still quite a high capital ask. So, yeah, it's difficult, John.
And I wanted to mention another thing that I thought about when Richard was talking about the recent pullback in equities and the indices not being very much. I have been in situations just like this where the pullback, okay, it was small, but it was material to me. So that's in the other, the part of the equation of trading too large. You know, I, that if from so that panics people. And so that's why it's so important to trade small and risk 20 basis points, 25 basis points per trade with a healthy ATR max loss, not one or two. So figure that equation out. Um, how small do you have to trade to lose 20 basis points or 25 basis points max, but have a healthy ATR loss? So you're going to be trading pretty small, and so you're immune. It's a superpower. Um, I remember going up to Rich and asking him during the turtle training class, what are the I asked him, what's the biggest mistake we're going to make? And he said, not getting back into the trade. You got to get back in. Once you get out, get back in. But the two principles I think that stuck with me for the whole past 35 years that have proven to be 100% true. All of my issues have revolved around two things, and that is trading too large and not following my system. And they're sort of correlated because frequently I was trading too large, which prevented me from having a long-term, more profitable viewpoint of not letting something like this materially, financially impact me. I have a stock opening up today. You can probably guess which one it is, and it's going to open a lot lower than it closed yesterday. So it's not going to bother me too much because I trade it pretty small. All my trades are small.
Hey, hi guys. A little slow here. I think I've got the COVID finally. But back to our trend following topic. Jerry just said one should have a hefty room for stop loss. What do you think is enough? You just said, well, 2 ATR is not enough. Okay, I agree with you, but what's too much? 10 is too much? 15, 20? What do you think?
You don't go too extreme. You just marginally lift it and extend it. So, if you're trading a composite of models where initially you were fairly short term, you might have had 2 ATR, 3 ATR, 4 ATR, 5 ATR. If you then step out to longer or medium to longer term by perhaps going, 4 ATR, 5 ATR, 6 ATR, 7 ATR sort of thing. So you don't do it in vast increment jumps. You step it out as a collective with your systems, and you extend your look back as well. That way, you tend to therefore preserve the non-linear market features in both the short-term distribution as well as your medium-term to long-term distribution, but you increase the relative frequency of the outliers in relation to the linear trades, which are a combination of small wins and small losses. You increase the relative proportion of those non-linear outliers to the linear trades that are the bulk of your trade distribution. So with 5 to 10% of your trade distribution being your outliers, 90% are your what I call the linear trades, which could be losses and a combination of losses and small wins. So by stepping out with a progressively longer look back and also stretching your ATR stops and trailing stops, you tend to preserve those nonlinear features, but you get a far lower representation of those linear events, which therefore means that your overall performance improves and you're still targeting those same outliers in your distribution.
Yeah, I just, I'm not going to take the joy of doing your back test and give you my answer, but when I did the back test, I optimized for the most amount of profit, and it comes back with larger than the old Turtle 2 ATR. And then when I took it off completely with no stop loss, the average loss was the same, as the parameter that I had chosen due to choosing the best parameter for that stop loss. So it's kind of funny. And so I don't know if there's anything to that, but I've also traded a range, 4 to 10, let's say, ATRs. But just because at one point I was obsessed with multiple parameters and trading hundreds of different systems because we had programmers and computer power to do it, and assets to trade. But and then I would just obviously want to emphasize that this is losing trades only. So I don't use a ATR approach on liquidating profits. I use that breakout approach. And so whereas I'll limit my losses to 20 basis points, try to, maximum, I will let my profits fluctuate, 100 basis points or whatever, right? So it's a profitable trade is scary because that long-term breakout exit doesn't move up very fast. It's not, the moving average crossovers move up every day. If the market makes a new high, the moving average crossover moves up. It captures that. It just makes you feel so good. So since I don't want to feel good, I want to feel bad. The breakouts have a stair step and they don't move up, so they're superior in my mind because I look at all this profit I'm going to give back and how frightful that is and how everyone would hate that. Overall, at the end of the day, it's a superior performer because it loose parameters helps you pick up the 300, 400, 500 ATR profits that the back test says those parameters and that strategy is the best.
Is there? I don't want to get any information that's not public about the Turtle Trader program, but how many days is the ATR over in general?
Yeah, I optimized that as well. I think we use 15 and I think I use 20. Yeah, so I tweaked the ATR calculation a bit because I wanted to do the back test way, and I don't think it's very important if it's 15 or 20 or maybe even longer. I think I've read where some trend followers use a longer term look back for the ATR. But I wanted to do it two different ways. I thought that ATR had some characteristics, fundamental characteristics when you use it with the data. So I would do the back test and see which worked the best, which I don't think that it really matters very much. The consistency is what matters, using the same one and being consistent. And then I wanted to put the data in a spreadsheet as well and see the relationship of the ATR to the data, and it confirmed the back test. So I like to do it two different ways: optimize, and then what's going on with this ATR here? What does it mean? What should I expect this ATR to achieve on a daily basis, risk-wise? What's the characteristic of the proper ATR? So I was kind of obsessed with that, and I was able to confirm in two different ways that my ATR calculation tweak was a pretty good idea.
Thank you.
So, Jerry, you're referring to if there was any study or any paper on trend following on stocks. So I've just tweeted that I'm sure you've seen that old paper by Longboard, or as they were called, Black Star, by Eric Crittenden and his partner Cole Wilcox. So I think that's a pretty comprehensive. I think they've done a backtest over 22 years. Uh, Systematic trend following on with the 10 ATR stop loss, trailing stop loss on US securities. It's fairly comprehensive. I've sort of put that in the Twitter link, so I think that will be useful. And it's pretty they used like a 10 ATR stop, trailing stop, and they've sort of bought every stock at the breakout, and it's interesting. I mean, and they've done far better than the S&P over the period at least, and the data seems to be fairly comprehensive, free of any survivorship bias. So very interesting paper. I'd read it a long time ago, and when you asked again, I was reminded of that one, so I dug it out and tweeted that paper.
I love that paper, Anish. It's a great paper, and I refer to that always. When I hear someone like Andreas Clenow make the bold statement that trend following doesn't work on stocks, I think he was more throwing out something to question. I don't think he necessarily categorically believed it, but that paper by Eric Crittenden certainly justifies a trend following approach to stocks over the data that was presented to it. I know the data is fairly old, but it's certainly sufficiently recent to give me confidence that our trend following models do work very well on stocks.
Yeah, I know Eric and Cole. I've known them for a long time, and Eric has a good mutual fund, CTA trend following fund. Standpoint is his firm, and they have an allocation to long S&P. So their strategy, marketing strategy, or whatever you want to call it, is diversified CTA trend following plus a permanent long in stock indexes, various, I think, stock indexes. So you don't have to make the decision to how much to allocate. They do it for you. And then if the CTA trend following falls way behind, which seems to irritate people, the diversifier, they want to get rid of it. But then if the stocks are doing well, um, that picks up the performance of the fund. So that's one way they have a really good strategy. Yeah, they use, I thought it was 15 ATR retracement. Um, and so, yeah, I mean, it's just hard to fathom that what's the problem with raising money for CTAs in the past 10 years has been stocks were so darn good. And then to ask the question, does trend following work on stocks? Well, I mean, it's probably the best sector out there recently of equities. As long as you trade the single names, you get the more outlier possibility, in my opinion. But probably with indexes, anyways, they've probably been pretty darn good. But I asked Eric this question one time. I forgot why I asked it. He's really good with data and survivorship bias and things like that. And I probably wanted to downplay the problem of survivorship bias. I just hear this all the time, and I ask him, is there really a problem, not including those equities that have gone out of business or merged or whatever? And he thinks that it is. But I said, look, have you ever tested with your trend following system the stocks that are no longer around? Like, how did they perform? The ones that went out of business or merged um, or got bought, how does that group perform versus the stocks that are still around? And his response was about the same. So even all of those stocks that the Enrons of the world, the performance with trend following was like the same. So it doesn't really matter. Trend following, it doesn't matter what you throw at it, which markets, which stocks, commodities, currencies, bonds, it's going to have pretty similar performance. Um, yeah.
As I say, as I always say, maybe in every our trend following trading club session, that there are general laws of nature, and if we look at the weather chart, and theoretically, if it is an asset class, we can apply trend following very successfully to the weather chart, to the chart of weather. So in my region, for example, we can see from March to April, from +7 to +12 degrees average temperature. So it's flattish period. Some days maybe +5, some days +15. But in the second quarter of May, we see 30 degrees. So what Richard has +1, -1, +1, -1, +20. And we can apply this to a lot of processes in nature.
Spot on, Oleg.
I think to Jerry's question of survivorship bias, especially in equities. So we've done that study in India, and we found that there wasn't a lot of difference if you took survivorship bias data versus adjusted data. By adjusted, I mean adjusted for survivorship bias, because the rationale that we sort of thought or we discovered also in the data was that as companies which got delisted or uh, went off the exchange or got bought, their size was the impact on the overall market was fairly small, either because these companies were not doing well, so they became smaller in size and therefore less significant. Uh, So over a long period of time, and I think it was about 25 years of data that we looked at, and not much difference in the returns over a period of time. So I think Jerry's spot on with his observation.
I think if you don't regard the delisted stocks for absolute momentum or trend following on these particular stocks, it shouldn't matter that much. But if you, let's say, take S&P 500 index stocks and try to come up with a momentum or relative strength, relative momentum model, then you need to see which stocks were in the index at the time of taking the trades, and there it's maybe more necessary. But the Andres Klino's book you, Richard, mentioned, I actually read the book like a week ago, and he wrote there about the classical trend following, not working on stocks, mostly about the shorts, that it just statistically on a long-term time scale and on a large sample size, shorting doesn't work the same like going long, because the long-term return in the stock market is like plus 5 or 6% annually. And another point regarding it was that if you just trend follow all the S&P stocks, it doesn't add much value. And there he also brought up the momentum part.
Yeah, we don't really need it to add much value. But what does value mean? To me, having a smaller drawdown than 50% and making close to the same amount of money would be tremendous value. So you'd have to define value. Um, it's going to be different maybe for everyone. And then if you can get the 25% drawdown versus the 50 or 60% drawdown, you can leverage up the stock trading and make more than the 8% or get back to the 8% if you need to. And these things change so often. Stocks outperformed before 2008. They outperformed trend following the stocks. And then after 2008, stocks were in a negative position over the past 10 years. So trend following is underperforming now. That's what it does. It underperforms until there's a crash, and then you make it all back. And then hopefully, once again, it'll all reverse, and another bull market will ensue, and trend following will start losing again. Trend following is mainly for people who have a hard time sleeping at night, thinking that their downside is somewhat unlimited, but their upside is limited. And no secret that there's a lot of accountants in trend following, me being one. I think another thing that's kind of interesting is, I think ironically, not including delisted stocks. If you include delisted stocks, it should make the trend following performance a bit better, because if you just look at the stocks that are still alive and have been growing and are part of the S&P, the shorting opportunities wouldn't be as great with those by definition because they've been going up. That's why they got included. And then the ones that had went down have been excluded from your trade stats and from your shorting, which may actually improve some of the short performance. Someone criticized my backtesting methods like 5 or 6 years ago and pointed this out to me, that I was not, I was doing backtesting and looking at short stock trades without the benefit of including those companies that had gone out of business. And I immediately agreed. I said, yeah, you're 100% right. I totally screwed that up. So that's kind of funny.
Actually, Jerry, something that's very interesting to me is that when we talk about we've got a model and we think it's working really well and we're tempted to increase the leverage to do even better, I'd say no, don't do that. I'd say take the harder path and diversify wider with smaller bet sizes. So leverage implicitly implies an increase in your position size. So whether you You might get a margin equity to sort of increase the capital, which you therefore apply to your model, or you use that additional equity or that additional margin to actually diversify wider. If there's a choice to be made, always go the harder route of diversifying into more uncorrelated markets with smaller bet size than being tempted to increase your leverage.
Oh, 100%. That's exactly right. And I kind of critique CTA traders and trend following traders for not trading single stocks. But that's a small issue compared to the rest of the world who doesn't trade commodities, currencies, and bonds long and short. I mean, so they're the ones, you know, if you're trading stocks only, come on. They're not superior. They don't trend better. They have their day in the sun, just like commodities have recently, and they'll have a 10-year funk, just like commodities had. So that's the principle that all good trend following ideas leads back to one thing, and that's sample size and treating all these markets the same, longs and shorts, declaring that none of them are superior than the others, that adding diversification, there's no such thing as diversification from a systematic point of view, a betting style investment strategy. Um, your edge and your expectation is the same across all markets, and adding markets and trading smaller gives you access to more outliers and more safety.
Here, Mr. Speaker.
Yeah, that's all good, and I definitely understand all the trend following and trading 150 markets and all that stuff even better after spending my time here in Clubhouse. But as an equity trader, I can just say that it's much more easier and cheaper for a small retail trader. And the US stock market is so large that I think, me personally, as a small retail trader, I can diversify across strategies and time frames and do longs and shorts and all that kind of stuff. And I trade Bitcoin, gold, ETF, and euro dollar just to hedge my dollar account, since I'm a European, but I trade only the US stocks.
Exactly, Marcus. Unfortunately, with a small capital account, it's sort of like putting yourself in a rock and a hard place. You're actually forced or encouraged to trade or adopt convergent methods, to trade multiple different risk premia, because that's something you can achieve with that limited risk capital. However, what we're saying is that, clearly there is a capital barrier to trend following. So you've got to think innovatively at how you achieve what these diversified classic trend followers do within the means at your disposal. And there are a few solutions. They're hard to find, but I'd say I'd be investing my time in those things as opposed to falling into the trap of biasing your technique towards something that's convenient, because I think that puts you into the high risk category in relation to your ability to generate sustainable long-term returns. And I think all of us want to think that trading is something we can do for life, but there is nothing worse than risk of ruin to totally sort of end that life. And you've got to choose a method, therefore, that is sustainable, treats risk seriously. These alternative methods are inferior because there is this inherent risk associated with them, or which you don't find in the models that we're proposing here.
Yeah, and unfortunately, in order at this point for me to add more markets, I'm looking into stocks, and I'm looking into stocks that hopefully have some sort of commodity edge or angle to them, supply chain problems, supply demand problems, let's say. But there's still going to be stocks, and if it's a stock that mines lithium or uranium, or is associated with a commodity, it still may not be as as a good performer as, or lumber. There's some stocks out there that look like the lumber chart, but if they do today, are they going to look like lumber the next time lumber has a big run up? Could be better or worse. But the one thing that I don't care about at all is finding the next best stock. I don't even want the next best stocks. I just, because I want some shorts. I want to choose these stocks solely based upon that they're different, and they won't all be long or short at the same time, hopefully, even though that's a possibility. But we're kind of weird in that we're looking for this diversification, especially for outliers' sake. Semiconductors, that's been a big move, and almost all of those things have been a big, huge run up. So there are ways to hopefully tilt the portfolio towards something that could happen that would maybe act like a commodity or be a bit different than the S&P. Now, like I said, now so many of my stocks that I watch and that I trade are in downtrends that they look nothing like the S&P. So I'm happy about that because I know I've got a good portfolio for the long term. I think I told you I found this one stock and I'm so proud of it. It's the largest egg producer in the United States, and it's pretty much a pure play. That's another thing I'm looking for is I don't want a conglomerate. I don't want a diversified company. I'll handle my diversification myself. I want a pure play as I can get on something. And I found this company, and I think it has 75% of the egg market in the U.S. So, and a friend of mine compared it to the Chinese egg futures, and it looked a bit similar. So I think that's the perfect scenario for me. Okay, does anybody in the audience want to have a word with all of us and ask a question or some comments? Or anybody already up here want to give us a parting comments before we call it a week? Okay, fair enough. It's been fun. Hope everybody has a good weekend. And we'll see everyone next Friday, same time.
Have a great weekend.
Thanks, guys.
Goodbye.
See you, everyone. Thank
Bye.
you. Bye.
Thanks, everyone. Goodbye.